Good afternoon. Good afternoon, traders. Welcome to Paul's Monday Market Update, number 217 for Monday, 9th of March, 2026. Great to be here. Hopefully, we will not have the tech problems that we had last week. Apologies again for that. I think that was just every man and his dog was on the internet that day, and for obvious reasons, which continue and give us a lot of the detail for today's session. Whether you're joining us live or whether you're watching the live stream, I hope that you can see the slides. Hope you can hear my voice. I hope that you are well and safe wherever you are joining and watching us from. The Monday market update is just that. It is me flying through as much as I can cover in the next 25, 30 minutes, looking at strength and weakness within FX markets, looking at some charts of interest to add to your watch list, and then a look at the live markets. It is not a signal service. There are no trade recommendations. It is just me sharing what I'm looking at, which may be of relevance or help and support to yourself. As always, you are very welcome here, but just remember you are always responsible for your own trading decisions. Also, if you want a little bit more help and support in your trading, regardless of how you trade or what you trade, the VTP Trader Accountability Group is up and running, helping people build discipline, accountability, and consistency in their trading. Okay. If you want more details, you can ping me, or once again, that QR code will take you to a page with more detail. Bang, charts, indices charts. All right. So what is this showing us? I've got Dow on the weekly, Nasdaq on the weekly, S&P 500 on the weekly, Russell on the weekly, FTSE on the weekly, Nikkei, DAX, oil. Okay, we can't not talk about oil here, can we? Based on what we've seen, let's start with that weekly chart. Look at that. All right, just boom. Look at that. We talked about how a few weeks ago we'd based out here. Okay, we'd based out. We kind of got above 60, above the weekly 50. But boom, having gone from about $62, $63 up to $119, $120, that is quite some move, isn't it? And that is a reflection of what's going on in the world and how people are responding to it. And what we saw was a lot of those Gulf states. Okay, this week have talked they're going to basically cut supply in terms of they're going to basically row back on their production because there isn't either the storage facilities or the tankers sailing through the Straits of Hormuz to basically get their oil out. Remembering that I think it's about 20% of all oil comes out through the Straits of Hormuz. We go down to the daily chart, just have a look at it. We can see it. In fact, it might even go down to the hourly chart to show. Last week we had a great run there. Okay, at the end of the latter week, it was interesting that quietly interesting the kind of the pace of oil accelerated after the sinking of the Iranian destroyer. I think that's when people's minds started to think that this was going to be a longer and wider conflict, and that had that impact. The fact that it's continued, well, we can see that basically oil up massively, pumped in the Asian session. Now it did start to fall back and has fallen back to 100, but clearly it's looking like 100 is a level of support there at the moment, isn't it? Now, of course, we'll see what happens when the American markets open in a short while, but that variable in the electronic contract, we can see 100's acting as support, big round number. It did not fill the gap, so if 100 doesn't hold, it would not surprise me if we filled a gap there, but it also would not surprise me if we held above 100 because it would cause some people quite a bit of pain. When we look at the indices, okay, appreciate for time. Well, Dow, it's nowhere near 50,000 now, is it? And it is just literally sat on its weekly 50-period moving average. Nasdaq, okay, the weekly movement has been to the downside. S&P 500, okay, here we talked about how we were kind of coiling up, sat on that 20-period moving average. That's broken. That's gone. We're down there. IWM, okay, was a little bit like coiling up and has also broken down there. Okay, that's where we're seeing the sentiment is not too happy there. Okay, and neither is it in Japan with the Nikkei. And also the kind of double top on DAX we talked about has continued there. We broke out. Okay, we put in our double top, and then last week we broke and we closed beneath the 50-period moving average. Okay, this is it's not to be sniffed at because I'm just looking here. It is back when was that? Back in 2023, November 2023 was the last time we had a close beneath the weekly 50. All right, that is a considerable distance. Okay, once again, then we gap down. as always, my always way is that I like to see, when I get a move like that, is it going to be a bit of a scenario of a pullback back up into the averages, which flip from being support to resistance before it moves down? Okay, that is, that's a bit of a simple textbook move for me. Okay, nice double top there. Pull back, okay, form another lower high before it works its way lower. Okay, that's the scenario that I kind of like to take advantage of when it plays out. If it doesn't do that, well, I do nothing. FTSE, FTSE, there we go. The party is over there for the moment, isn't it? We've just literally having started once again, getting higher, pulling away from the moving averages. That sort of ended last week. Not a surprise. Look at the daily chart. Daily chart, okay, we'd had the 20 period moving average acting as dynamic support there, providing it. Didn't this time, came down to it, just failed it, got beneath the daily 50, and it's working its way back down towards this kind of 10,000 region there. That's what we're looking at there, okay. And then, as I said, we've got Bailey speaking on Thursday. We've got UK GDP on Friday morning as well. That will probably be as insipid as it has been, okay, for the last 18 months. But then I think a lot of this is also going to be impacted by the nature of the conflict we find going on in the Gulf at the moment. Quick look at here we go, gold. Interestingly, okay, having gapped up, we've kind of fallen our way back and we're sort of sat above 5,000 there in the daily chart. Okay, that's from last week. We gapped up. People might be scratching their head and saying, well, actually, Paul, I don't understand it. Shouldn't gold be absolutely rocketing? Yes, but what you can see is that there's probably people being involved in here for months, maybe even years, and invariably what tends to happen is that if you are caught on a margin call as an institutional trader, if you've been caught on the wrong side of that oil move, or you're caught on the wrong side of the dollar move or other equity moves, well, then invariably to avoid a margin call, you're going to have to basically cull your profitable positions first to basically balance the books. And I suspect that is what we have seen with gold. All right, that's what I think we have seen with gold there. That would be my kind of view at this particular moment. Silver, kind of similar. All right, silver on the weekly chart there. Just look at how we did gap up, yes, last week, but we've just fallen away down to sort of at $80 there. Where the daily chart there is interesting. It's sat between $80 above and the 50 period moving average above, the $80 mark beneath it. Okay, and we're just kind of pivoting there just to see what happens. If we see continued sort of underwhelming sort of data out of either companies or economy, well, then I think the story for silver starts to sort of roll away a little bit. That would be the kind of what I'd be looking at the moment. Bitcoin, if anyone's even remotely interested in it at the moment, I thought we were kind of slowing down here, and I thought we might get a pump and a hold above 70,000. That didn't happen. Okay. You can see here on the daily chart, we kind of just went sideways. We pumped up above and came all the way back down. Yep, we're nudging our way back towards there. But I think at this moment, that's probably just another indication of people's view of risk, as in nobody's interested in risk at this particular moment.